As people are still joining, I wanted to welcome you to yet another EEGC webinar. It's part of the EEGC webinar series. Today, we'll be talking about crypto in gaming, and we'll focus on different topics, including probably the most interesting topics for the community: regulation, risks, and how we actually use that to run our businesses. Okay, before I start, rules of engagement. I hope to make this webinar not a presentation, but a conversation. So I would highly appreciate if you interrupt, ask questions, etc., etc. I will make sure I can see everybody. Yeah, okay. Let's hope that we can make it work in the digital space. So, As let's start with a short presentation of myself. My name is Stoyan Atipov. I'm a founder at the Institute for Direct Finance Professionals. This is an academic space where we explore blockchain, AI, quantum computing, cloud computing, etc., and how they apply in regulated finance. We are we have gathered some of the brightest minds in academia and in the professional space from across Europe, and collectively we are working towards building a shared body of knowledge, so we can advance the collective practice. What actually pays my wage is my work at Vesto. Vesto is a software provider for crypto-related businesses. Basically, this is a place where you can buy all the components you need to adopt crypto in your business. For me personally, I have already 18 years in the IT industry. I started fairly early. Five of the last 5 of them have been in regulated crypto because this is basically for that much time we had regulations on crypto around the world. I started in Singapore. Then when the EU adopted crypto regulations, I moved back to Europe. I bought my first Bitcoin in 2009. It was just $4.80. Looking at the market right now, it feels like we're going back to that price. That's not true. Anyways, you can also find my contacts at the bottom there if you have any further questions in the future. So, first things first, it's a common misconception that crypto is something that has no regulation around it, and it's something that's outside of the law. Especially when it comes to gambling, everybody believes that okay, this is like for black markets, for illegal operations, etc., etc. Well, let me be the first one to tell you this is absolutely wrong. The world has been regulating crypto for 5 years now, and for the last 3 years, two of the biggest economies of the world, basically half of the global GDP, have adopted really extensive regulatory frameworks on crypto assets. So in Europe, we have markets in crypto assets, which is the crypto specific act. But sorry, but as we use crypto for payments, a lot of the provisions of the Payment Service Directive, PSD2, that was adopted in 2018, also apply to crypto operations. In the US, they fairly recently moved on the topic. They lagged significantly behind Europe with the Genius Act and the Digital Asset Market Clarity Act. Um, of course, it's not just those two jurisdictions. As I mentioned, I started my career in regulated crypto in Singapore. They have adopted their regulation in the late 2020. Um, then basically, I believe any major or at least significant in the financial industry jurisdiction around the world has some sort of modern regulation on crypto, but more or less everybody follows in the steps of Europe. So, and because we are based in the European Union, I'll focus mostly on the mechanisms that Europe has introduced. Um, okay, so what is MiCA? MiCA is a comprehensive regulation that covers about 10 activities you can do with crypto and organizes all known crypto assets in three categories. The three categories are e-money token, um, asset reference tokens, and others, the prolific others. So, what is e-money tokens? That's basically tokens that are fixed to an existing fiat currency. So a token that always costs €1, $1, or one whatever currency they're pegged to. Um, Later on, we'll talk how those tokens work, but you should remember that there is a category called e-money tokens, or as they have been known for the last 15 years in the real world, stable coins. The second category are asset reference tokens, tokens that represent another securitized asset. So they can represent a share in a company, they can represent a government bond, they can represent uh, commodity futures, etc., etc. Um, so with them, the situation is a bit more complicated because some of them are treated as securities, some of them are treated as utilities. And that differentiation impacts significantly the way you need to license in order to issue and operate such tokens. And the last category is others. So most of the known crypto assets fall in that other category. So all the Bitcoins, Ethereum, Solanas, etc., they're all in this others category. Basically everything that's not an e-money token or asset reference token. So why is this important? The European Banking Authority in early 2025 issued a statement that e-money tokens are the same for all intents and purposes as e-money. So your digital bank balance is exactly the same as those e-money tokens. Um, when you oh, uh, I was just told that the presentation cannot be seen. I hope you could you please share in the chat if you can see the presentation? Somebody? Okay. Sorry for this small technical glitch. I really hope you can see my screen now. Um, hmm. Now we do. Okay, great. Okay, thank you very much for that. Um, well, at least somebody notified me at some point. Thank you very much for that. Okay, going back to the topic. As I was saying, in Europe and by extent in the US and every other jurisdiction, uh, e-money tokens or stable coins are treated as fiat money, as digital bank balances. Um, that said, this basically means that you can accept payments in e-money tokens. You can make payments in e-money tokens, and these are legal payment tender. Um, so for now, I'll ignore the other categories as I believe e-money tokens are the most useful and the most understandable for the larger audience, and probably the first thing that businesses would adopt anyway. Um, okay, so what are stablecoins or e-money tokens? So how first, the two most popular e-money tokens in the world are USDT or Tether and EuroC. USDT is the most prolific e-money token in the world. It's pegged to the US dollar. So basically, one coin is equal to $1. Euro C, the blue one, is a similar token, but it's pegged to the euro. What is specific about Euro C? It's actually licensed in Europe, and so the company behind Euro C is called Circle. They issued that token. Circle acquired their EMT license in Paris, so the French regulator manages this particular token. So EuroC is a full-fledged legal tender in the European Union. You can use it as equivalent of a euro. Okay. Um, I see that Stefan is asking how can smaller studios realistically stay compliant without excessive legal overhead? Um, Let me finish what the stablecoin is, and I'll move into operations, mostly payment processing and actual casino operations, and we will be touching on that topic at any step. Any step. So basically, how these coins remain exactly $1 or €1. Well, it's fairly simple. Somebody comes with real dollars or real euros, deposits them to okay, let's like it's simple. Let's talk about EuroC and the company behind it, Circle. So basically, you send dollars to Circle's bank account. They do some crypto magic and they issue new tokens that they send back to your wallet. So what happens for every token in existence, there is at least €1 in that bank account. Um, Here is the interesting part. The EBA recently came out with a statement, and recently, as recent as a month and a half ago, came out with a statement that they're open to tolerate e-money tokens without full coverage. So this means you can have uh, partial liquidity to your assets, and they floated a number at 30%. What does this mean? Um, let's say you want to issue your own stablecoin because legally you can. Um, if you issue a stablecoin, you can take 70% of the money and invest them into what is known as cash equivalents. So, for example, government bonds are cash equivalents. So you take, let's say, your players deposit money on your platform. They're turned into those stable coins. 70% of that amount that is currently stable coins and property of the players, you can invest in government bonds and earn interest on that. So that's a massive revenue stream. But that's usually reserved for bigger groups in the industry. Smaller players can just adopt existing stable coins. I would again advise towards EuroC as being fully compliant with MiCA, licensed and impossible to challenge legally. Um, so why is this important? Like, how is this beneficial to you? Uh, think of how much you're currently paying to your payment processor for every incoming transaction. With these coins, you can legally set up a wallet, accept those payments with those coins, and each transaction would cost you, depending on the chain, something between 0.2 cents up to 25 cents per transaction. So practically nothing. If you want to just use crypto to replace your payment processor, you can do that, but you need to have a partner who has any sort of license that allows them to exchange between crypto and fiat. So the partner that you need would probably hold what's known as CASP, Crypto Asset Service Provider. That's a type of license. and potentially an EMI or payment institution or full-fledged banking license. These are the institutions that can receive the crypto tokens, turn them into fiat, into real-world money uh, that they can then send to your bank account. Of course, you can just accept the stable coins, keep them on your account, or exchange partially. There are many ways to manage your treasury. I believe you're more knowledgeable in than I am. Uh, but frankly, the better case is if you actually adopt stable coins in the internal operations of your casino. So how does this work? You need two parts to that solution. The first one is identity management. So as you're already familiar, you have AML obligations with every customer that you onboard. So much like today, you identify the individual, you identify you ask them for a number of documents based on their transaction amounts, based on their profile and risk assessment. And after you establish who that individual is, you also whitelist bank accounts. Okay. When you're working with crypto, you whitelist crypto wallets. How you can whitelist a crypto wallet? Fairly easy. The customer goes to your platform and states, okay, this is the public key of my wallet. Um, I own it, I control it. So your platform then generates a request to that wallet that he has to sign in order for the wallet to be whitelisted. So basically, like how it works in practice, I go to your platform, I register, go through the KYC, then once I'm approved as a customer, um, you can I can whitelist my wallet, so I provide the public key of the wallet. Um, you generate the transaction. I get a notification on my phone. Hey, casino.com or whatever platform wants you to confirm your wallet. I press sign or yes or whatever my wallet interface is, and you get a message back to your platform that says, okay, yes, Stoyan confirmed that transaction, that request. Um, what's specific is that usually those messages would be exchanged through APIs. In this case, they're exchanged through the blockchain, which means basically that they're publicly posted. So uh, it's not just that you and I can see that I confirmed the request, but everybody can see that I confirmed the request. Of course, what everybody would see is basically wallet ABC123 asked a wallet XYZ 678 um, to transact zero with that message, and the message is some encrypted gibberish, and they would see that I executed the transaction. So they won't be able to decipher who is the request coming from, who's the receiver of the request, and what is the body of the request. This would still stay private unless somebody knows my public address, your public address, and can decipher the communication we have. So they have the private key for your encryption, which practically cannot happen unless you give it to them. So once you have that customer onboarded and their crypto wallet whitelisted, they can now gamble directly out of their wallet. So they don't have to deposit anything to your platform now. They I can use my current existing wallet that has already some amount on it, and I can directly start playing on day one. So um, another great thing is that once you have established legally that me as a person, I control that wallet, I can also use that wallet to log in. So no username, no password, no nothing. I just go in and say, okay, I want to play that game. This is my wallet ID. It generates a request. I confirm it. I can start the game. So basically, with this setup, uh, your customer doesn't have a barrier between his private money and his gaming money. You can implement it this way. Of course, for compliance reasons, because legally, this is not forbidden. This is absolutely okay as a setup. Practically, you can see how this gives a brutal advantage to the operator when the players just have no segregation between their overall money and their gaming money. So you can imagine that a lot of regulators would frown upon this. To make sure you always stay compliant, no matter what, my advice would be to set up gaming wallets and whitelist only gaming wallets. So you still keep that step in which the player has to transfer money from his crypto wallet to his gaming wallet. Um, so it's an additional hurdle, an added step. By the way, you can always add it pretty fast. So again, this is the simpler implementation is not illegal in any manner. But if your local regulator decides that, yeah, this implementation is kind of questionable, you can quickly add that extra step and replicate the fiat process, therefore satisfying the request from your regulator. So it's fairly easy to adapt. Okay, so once the customer is on your platform, he has his wallet directly connectable to your games or their through a gaming wallet, he can connect to your games, but he can start playing. So that's the other thing. You can serve your games through your platform, through different messaging platforms. There are many channels today. Um, with blockchain, blockchain, another term for blockchain is decentralized ledger technologies. And decentralized is the key word here. Being heavily decentralized, this allows you to decouple the components of your platform. So basically, every game can be treated as a standalone application. You just need the game to have a smart contract attached to it. So basically, the wallet connects to the smart contract. It does all the communication to initiate a gaming session. When that communication is done, the game can start. The user starts playing. Every bet, okay, let's say we are playing slot games. So every spin that he makes is recorded as a separate transaction between the customer's wallet and the game's smart contract. So every movement is recorded on the chain. Why is this valuable? Well, because now the performance of your game is fully public. So if anybody doubts that your game is skewed, or maybe like it pays out less often than it's supposed to, or maybe someone has been playing around with the configurations and with the RTP ratios, they can actually go on chain. There are plenty of explorers for different chains. They can go on chain, open that smart contract, and see every every player or all the players over the last X amount of days, and see basically how much did they bet, how much did they gain. So they can see the RTP in real time on chain. That's fully public. So nobody can question your integrity anymore. Nobody can say, "Hey, you know what's the common complaint to your support teams? Your games are trucked. Your RTP is messed with. I'm losing way too much, and I'm not winning as often as I want or as I expect. Your games are not fair." Now you have public proof of fairness. Of course, there are a bunch of products that simplify that because nobody wants to do manual calculations on raw data. So there are a number of tools that actually track in real time based on that raw data, how individual games are performing on your platform. Um, you can filter down to an individual game in an individual operator. You can filter even further down to individual game, individual operator, and individual player playing that game with that operator. Um, so basically, you can even show different players their betting history and analytical track record with that game. So this applies to any sort of game. Uh, it applies to bonuses as well, because individual spins are on the chain. The bonus can be again a standalone thing, completely separate from the games, that just reads into the raw information on the chain from different games, and it can be potentially triggered. Um, what else? Oh, sports betting, another major topic. As you know, poly markets are prolific nowadays. Um, they are really so. This is a code, by the way. The technical term for poly markets is futures markets and or prediction markets. And prediction markets are really interesting as a technology. And even though poly markets as an operation is not fully compliant because they have no gambling license and they're obviously a gambling platform, this doesn't mean that the technology behind it is illegal. As long as poly markets acquire a gambling license, they can continue doing what they do. And as they're facing scrutiny today, over the last few weeks, I am fairly confident that this is what will happen in the coming months. They'll just acquire a gambling license in some Caribbean jurisdiction or potentially the US, because this is where they're facing scrutiny from. Um, Poly markets are a bit more complicated as a technology, but what you should know is that every market, so basically everything you can bet on, because okay, we know sports betting, so that's every, let's say, football game or a tennis match or whatever. But if you go on poly markets, you would see that people are betting on political events, people are betting on pop culture, people are betting on whatever. Um, so with prediction markets, every individual topic that people can bet is called a market, and each market is effectively a smart contract, much like the smart contracts you need to connect to your games. Um, Again, these are template smart contracts. So if you want to adopt this in your operation, you need, I guess, one type of smart contract for your casino games, another type for your prediction markets, mostly sports. Um, Again, this is highly decentralized approach. So it means that you can serve individual markets, individual games, individual bonuses through different channels. Um, it opens an uh, endless field of experimentation of an opportunity to see what works best for your audience. Um, in this presentation, I'll skip how to use these things for customer attraction, promotion, and general marketing. But I believe once you get the hang of it, you'll be even more creative than I am. Um, I just want to take a moment to tell you about the system side of all of this. So please bear with me. So as I mentioned, all you need is identity management and then wallets, custody. So identity management, you need some sort of self-sovereign identity that is extended for custody management, AML compliance, and in the case of our industry, affiliate management. Um, So, and obviously, it's a good idea to have some API just to simplify operating with this overall system. What's self-sovereign identity? Basically, this is like a private blockchain in which each wallet is a person, and the AML compliance arc or add-on is the portion that basically allows you to put a number of raw documents and validations in that wallet so that you know, okay, this wallet is this exact physical individual. Um, so I won't bore you with the details, but basically all your AML checks, sorry, all the AML checks that you normally perform with an AML system, their results would be published on that private blockchain um, in the self-sovereign wallet of the individual. So at any point, if somebody wants to inspect a particular individual or your AML compliance, you just give them access to the private blockchain, and they can explore all the information they want. Usually, that's something that you do with the regulators. Custody management is actually a pretty interesting add-on that I highly recommend. So it is. So most wallets that people know are basically an application that you have on your phone. Um, those wallets usually work for one chain. Let's say, for example, MetaMask works for Ethereum. Um, so it's one person operating on one chain. This is what most people understand when they say a wallet. What if I tell you that wallets can be managed by multiple people and they can operate across multiple chains? So this is called multi-tenant, multi-chain wallet. To create multi-tenancy or to allow multiple people to operate with the same wallet, you need to have some policies in place which dictate how decisions for the assets in that wallet are taken. So, for example, if three people own a wallet with 10,000 euro in it, um, how much money can an individual person, like any of those three, spend without scrutiny? What, let's say 50 euro. Okay, but what happens above 50 euro? And that's what is this 50 euro per single transaction, 50 euro per week, per month, per year? Um, and let's say, okay, they have imposed a 50 euro limit per month. Okay, great. Um, what if we need to transfer more than 50 euro? Well, then you need a second signature. What if you want to transfer more than 5,000 euro? Okay, then you need a third signature. So all these policies that are uh, implemented according to your business are usually handled by this custody management add-on. Um, so why do you need this? As I mentioned, it would be advisable to have gaming wallets, so not to allow customers to directly play on your platform. If you have such wallets, you can impose hidden policies. So by default, the user has full control over their gaming wallet. Um, so they can yeah, sorry. So the user has full control over their gaming wallet, but you can always so in your custody management piece, or as we call it, policy engine, in your policy engine, you can maintain multiple collections of policies, and you can say what collection of policies apply to each wallet on your platform. So uh, you have a new customer, he deposits, let's say 100 euros, starts playing. That's a golden customer, no problem there. But maybe that customer turns out to have a shady behavior, or maybe they I don't know, they win too much or lose too much, or like there is something that makes you concerned. You can migrate their wallet into a completely new set of policies. For example, policies that forbid them from betting more than 50 euro per day. or policies that require them to take some extra steps if they want to perform certain operations. Um, so basically, this is a way to implement multiple sets of policies that are equivalent of multiple levels of control you want to have over your player's behavior. So that's why custody management, even though not the most obvious need, is something that can greatly benefit you. Um, Custody management can also be implemented with external wallets, although this would be pretty invasive because, again, those external wallets are owned by the player, and therefore the money there are not uh, per se deposited in your platform. Therefore, you would be controlling money that are not deposited on your platform, which is quite shady, and I would not recommend it from legal perspective. I have a question. Do users want multi-channel wallets or does it mainly benefit operators? So far I've been discussing multi-tenancy and how it's beneficial to you mostly as operators. When it comes to multi-channel, so I don't want to get too much into technical complexity, but those tokens, both USDT and EURC, are actually implemented across multiple channels. So you can receive EURC via Ethereum, via Solana, via Tron, and I guess about 10 other chains. So let's say you have an Ethereum wallet and I have Solana wallet. I have EURC on Solana. Can I send it to your Ethereum wallet? No, technically that's not possible. Um, so that's why it's important as operators for you to have multi-channel, multi-chain wallets. Uh, Multi-chain wallets ensure that no matter on what chain your customers operate, they can always deposit, they can always play. So it's convenient for the players. It's definitely important for you as operators. So going back to the systems view, as I said, basically the custody management gives you multi-tenancy and ML compliance is also important. Affiliate management, um, it's um, it's the space where you keep all those affiliate agreements. Um, hey, if this person that you brought in does this or that, because usually agreements are not tied to a particular game or anything, they're tied to overall customer behavior. Of course, that should not always be the case. Now we did this level of automation. You can go into fairly complicated affiliate agreements. For example, you can pay them, I don't know, um, every seventh bet uh, that a person that an affiliate brought into the platform. So every seventh bet made by that person won't be paid to the operator, it will be paid to the affiliate. So maybe they're betting like 20 cents on a casino game. So the seventh bet is just 20 cents. Maybe they do six spins on the casino game, and the seventh one they're betting on a football game. So instead of getting that bet, you pay to the affiliate. I know this is a bad example, obviously financially negative for you as operators, but I just want to show you how detailed your agreements can be because everything is now fully automated and fully transparent. You can actually execute such agreements again through smart contracts on chain, and every affiliate can trace back individual payments or individual events from their agreement back to the actual event that happened on chain. So they can fully validate the entire flow of money without the need of you providing any additional reporting. So um, going back to the right side, which is custody, as we talked about implementations, we talked about wallets. So a wallet is a piece of software. As I said, it can be implemented just as a simple mobile application. Um, you can also take this application and host it on a server. You can make it an integral part of your of the platform that you're using. Um, the question is how safe those wallets are. So a wallet is usually defined by two components, a public and a private key. The public key is something that you publicly share. That's your address, that's your ID. So if somebody wants to send you money, you have to give them your public key. But what about the private key? Well, the private key is what really matters. This is what you always must keep secret, keep protected. And protecting the private keys is a fairly complicated task because you have to store them somewhere, and wherever you store them, they that place should be highly protected. You know that as a type of money business, your businesses have certain vague obligations. So the way the law is written, to an adequate extent, to the best of your ability, etc., etc., etc. So the very legal definitions are ambiguous, and they're left to the interpretation of the regulator. So when we are protecting the private keys of our customers, it's crucial that we can satisfy all those ambiguous requirements. For that reason, if you're going to use an enterprise-grade wallet, um, it has to first work with a identity management system that provides multi-tenancy, and second, provide multi-chain operations. So in the case of our wallet, for example, the wallet that my company sells, we have that. Um, our wallets currently operate with eight of the most popular chains out there. Um, okay, the magic happens in the so-called key vault. So key vaults are a component that implement different well-established technologies. You have multi-party computation, you have quantum encryption, you have hardened environments, etc., etc. So there are multiple ways to implement a proper key vault. I would argue that multi-party computation, although the most popular, is the least effective, not because the technology is bad, but because of the way it's implemented. So, just a quick run. What is an MPC? MPC basically takes the private key. It's a string. It's an alphanumerical string of 64 symbols, or 32 in some cases. So in this alphanumerical string, they take it and they do some magic with it. It doesn't matter what, and they generate five other strings out of it. So in MPC, you can provide four out of the, let's say, seven shards or resulting strings. So basically, take the private key, you destroy it, and you replace it with seven shards. If you have four of the shards signing a certain transaction, they can be used to restore the original private key through calculations and therefore sign the transaction on chain. So basically, that's a way to implement uh, three out of five, four out of seven, or X out of Y holders signing the transaction, so the multi-tenancy part. That's why it's pretty popular. What's the problem? Well, when you take the private key, you have to provide it to a system that will break it apart, to a multi-party computation system. The drama is that that system is a single point of failure. The channel that you feed your private key through is a single point of failure. You're moving the key. It can be compromised in that movement. Then you have the problem that okay, the shards come out. Where do you store them? A lot of operators, a lot of banks just keep them in a database. Guess what? Somebody breaks the database, they get all the shards. If you have half the shards, you effectively have the private key. So that's a problem. Then those shards, even if they're not stored on a database, like an absolute noob, um, those shards need to be communicated to their designated holders. So let's say you have 7 managers in the business, you want to give each of those managers a shard. Well, what's the problem? First, you usually would send them through some digital channel. It's quite often email. So you place all the shards on your email server. Guess what? Email servers are old. They're fairly old technology. They're easily compromised. You see emails being hacked daily. So if you put all the shards on the same email server, that email server now becomes a single point of failure. Guess what? All your customers, they're most probably using their business emails. So when you send the shards, they end up on a second email server that's equally easy to compromise and also a single point of failure. So that's why MPC, even though it's an amazing technology, the way it's implemented is not really effective. So I would advise you to steer clear from wallet providers that use MPC. For me, a good key vault is a key vault that originates the wallet and the private key never ever leaves the key vault. Um, you can implement this through hardened hardware environments um, or through certain quantum computing techniques. The latter are the only enterprise grade provider as of today is IBM, and it's pretty expensive. Hardened hardware environments are provided by most cloud providers, Amazon, Microsoft, etc., etc. So my advice is to look for a wallet that utilizes that feature. So that's basically the technical aspect of identity management and wallets. And let me get back to the questions. Um, So how do you isolate risk in a multi-tenant wallet system so one breach doesn't impact all users? Awesome question. So look, it was a fairly common practice to put all the customers' assets in the same wallet. Today, and it was fairly common because back in the day when this was established, like 2015, 2020, we didn't have such mature wallets, such mature identity management systems, etc., etc. So it was a fairly common practice. A lot of the exchanges, especially the big exchanges, still do this. They just have one big wallet where they mash in all the customers' money. This is a bad practice today. It should not be done, especially in the new implementation. First, deploying a wallet now is just a single command to the API. Hey, put a wallet. That's it. Um, especially like when you work with a cloud-based wallet, um, this is a single command. Um, so there is no good reason to not deploy a separate wallet for each separate customer, maybe even multiple wallets per customer. That's one thing. A second thing is the legal aspect. So in crypto, there is something called mixers, and MiCA and the Genius Act explicitly outlaw this practice. What is a mixer? Basically, it's a place where multiple individuals send their assets and then they can withdraw their assets from there. So, for example, every major exchange today is technically a mixer. So when you put all assets from multiple users in the same wallet, you usually have to keep a separate record, off-chain record, usually in a database, uh, who holds how much in that shared wallet. Having this off-chain data layer is illegal as of today. So if you want to implement it, just deploy individual wallets for individual customers. The multi-tenancy is again more of a mechanism for you as the operator to introduce control over the user's assets, because if you just give them full access to a wallet, you cannot stop them from working with your service or operating with that wallet. They can transfer money in and out of it without any restrictions. They can play your games without any restrictions. That's why you need multi-tenancy, so you can introduce soft restrictions without outright banning that wallet and that individual. Okay? Um, I believe this is the end of my presentation, and I want to thank you for your time and patience and attention. If you have any questions, feel free to post them in the Q&A section. I would love to answer. Okay. Um, okay. If not, thank you very much for your time again, and I wish you an amazing day. Goodbye.